So we all know that housing is pretty much unaffordable right now with the level of high prices that are still out there and of course mortgage rates at high sixes, low sevens. It's pretty much difficult for anybody to buy a house. There's a new report out that we're going to talk about today that basically forecasts housing market affordability set to return sometime in 2025. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here, putting the realism back in real estate. Today is the 12th of July. Hope you're doing well. Hope you're having a good summer. It's been a while since I've done a video. Yeah, I realize that. Reason being, I got lots on the go. I'm out constantly looking at deals, closing deals, doing stuff. Basically, this is the time where people take time off to vacation and do whatever, and we always try to amp up our business for sure. So that's what goes on here. So we're going to get right into it right now. So basically, if you're looking to buy, new report forecasts that housing market affordability set to return in 2025. So basically, we are in the most severe housing affordability crisis in a generation. Tens of millions of folks have been priced out of homes the past year due to skyrocketing borrowing costs and a shortage of supply that has pushed prices to mind-numbing levels. So yes, I do agree with that. Now, a lot of the stuff is metro-specific, so depending on where you live in the country, you may be seeing housing prices fall in certain areas, or yours may be maintaining or just inching up a little bit here and here. Basically, in June, the National Association of Realtors and Realtor.com published a report that found over 75% of the homes listed on the market are too expensive for the middle class, thanks to a rapid surge in the average 30-year fixed mortgage rate from 3% over 7% and a 40% rise in the national home prices during the pandemic era. So ultimately, these two things cannot coexist. You can't have, 40% increase in prices. So we're hugely, or grossly inflated with price points compared to the last housing crisis and compared to the past, couple of years. And we have mortgage rates have more than doubled. So, what are you going to do in this situation? You're going to do nothing. That's the answer. So most people are doing, which is causing concern for people who are involved in the real estate market, obviously, right? So that's kind of the scoop we're looking at right now. So there should be no surprise. It should come as no surprise. Simple as that. So essentially, excuse me, mortgage rates peaked around 7%. There's a group called Morningstar. I guess they did a forecast model, and they basically are saying that from what they're looking at in their modeling, the average rate for the year for mortgage rates will be 6.25%. They show a 5% for 2024 and a 4% for 2025. So their feeling is that the Fed has engineered a massive increase in interest rates in order to combat high inflation. We expect it to cut the federal funds rate aggressively in the coming years, driving the rate down from 5% currently to below 2% by 2025. That's what the economists at this group called Morningstar are predicting. Once the Fed wins the battle against inflation, its priority will shift to jumpstarting economic growth, will require much lower interest rates, in our view, is what they're saying, of course. Regardless of what happens next 2 years, we expect interest rates to ultimately settle back down at the low levels that prevailed before the pandemic. Well, we'll see about that. The low interest rate regime will resume once the dust settles from the pandemic economic volatility. They expect rising incomes and sliding home prices will improve housing affordability. Well, that would seem to make sense. Now, here's the thing. You can see where the interest rates are. This is a bankrate.com chart, the U.S. fixed, national average. So you can take a look at how low it was in 2020 during the pandemic cycle, and then we increased big time. Yes, small dip, and we're back up again. So again, this is what we're dealing with right now. Significant change in interest rates have affected the housing market. Basically, our revised home price forecast now projects new and existing home prices to decline 6% and 4% over 2022 to 2024, respectively. They call a downturn in home prices or a mild correction, noting a plunge in prices would be prevented due to inventory shortage nationwide. So maybe we'll see more, maybe we'll see less, depends on where things are going. We suspect sliding home prices is what the Federal Reserve is hoping for, and judging by mortgage rates, prices have a long way to fall. So essentially that's what they're looking at here, is the fact that we still got a long ways to go. People can buy homes. We're seeing that in the marketplace right now. Nobody's buying and slowing things down. Obviously, it's kind of interesting here. This is a dual chart. So the black line is the U.S. home price average, the Case-Shiller National Home Price Index. Obviously, the blue line is the average mortgage rates going the other way. is inversely proportional here. So actually, well, it's not inversely, just the way they've done the graph here. So obviously, the mortgage rate hit a 7.38%, and we saw a little bit of a trough, a little bit of some decline, and then a little pump back up for the Case-Shiller the last month. So that's what we're looking at right here. So highest mortgage rates in a long time, with pretty much almost record high housing price points here. Now, my last video, the U.S. housing market was out of whack right now. Don't know if you had a chance to look at that. That was the end of June, and guess what? This is this new article that comes up now on, I guess you could say, on Fortune.com. It's housing. Oops, I did that too quick here. Hang on, guys. Housing market affordability is so out of whack that the bulk of the drop in home prices is yet to come, says Pantheon Macroeconomics. So basically, which is interesting because this is a pretty good article. We saw a little bit of, an increase in some price points last month, a month before, very small. In their eyes, the U.S. housing markets bounce this spring was simply a head fake. So I do happen to agree with that. I think we always get, we call that the dead cat bounce essentially here. Whoops, sorry guys, my computer's moving a little too fast here. We're baffled by the emerging narrative in the commentariat that housing is now recovering because it isn't. So that's right. So the minute we see small dip in rates and some increase in activity on the sales front, whether it's values or sales activity, albeit these are very, very small, like tenths of a percentage point increases, the narrative, the media goes, oh, we've bottomed out, everything's good, let's go, let's go, let's go. Home sales jumped at the start of the year, lagging the late 2022 dip in mortgage rates, but they have fallen more recently thanks to the latest backup in rates. Mortgage applications signal they will soon dip to a new cycle low. The key hurdle to a true recovery in the housing market is affordability. Last year's mortgage rate shock, combined with the national home prices spiking over 40% during the pandemic, has deteriorated housing affordability in a way unseen since the housing bubble peak in 2006. Now, we had a pretty significant bubble or peak in 2006, but as far as affordability was going, it was more affordable back then. Even though it was tougher for people at the bubble, the 2006 bubble, it still was more affordable than where we are today. The broader point here, though, is that the bulk of the drop in home prices is yet to come. So that's a pretty powerful statement, by the way, right? We have not seen the bulk in the drop of the home prices. That's yet to come. The lagged effect of the plunge in sales points points to a steep and sustained drop. The speed and scale of the adjustment in prices is uncertain, but the direction of travel is clear. So we're going to get a price point drop. We're going to get value drops. It's a matter of how fast it's going to happen, how aggressive it's going to be, and when it's really going to take off. Remember, we always have to go back to the infamous words of Robert Shiller, who was the co-creator of the Case-Shiller Home Price Index. And I've said it in a couple of recent videos that his commentary is that, hey, if you're buying the house right now, you might want to maybe wait 6 months or so because you could get some better prices. And obviously the man is a Nobel Prize winning economist, genius type guy, and he's sort of putting it in the most simplest of terms for us to say, you might want to hold off on that purchase if you're looking to get a better price, because quite frankly, he sees the signs, he sees the trends. What we look at every month when I do these videos in Case-Shiller, it's his creation, it's his index, right? So, a lot of people who are in the know are basically saying, hold off. I can tell you from what I'm seeing in the marketplace, again, wholesaling slowed down. We're seeing less wholesaling deals. We're seeing reduction in prices. We're just seeing low buying volume going on right now. I know the fix and flip world, there's a lot of people aren't buying properties to fix and flip because they're going, we can't buy it at today's rate. Homeowners are still, even though it could be distressed property that needs to have, to be rehabbed, et cetera, for a fix and flip, they are still the belief, people are going to come and bring me wheelbarrows and boatloads full of money. Well, that's not happening right now. If you engage in properties for fix and flip rehab projects, you got to buffer in at least a 15% slide 6 months out now from when you sell because of the downturn. It's actually happening now. It's happening at a small level. It's happening large, bigger levels depending on where you live in the country, but it's actually happening. So you have to predict for that. So as I always say, the feet in the street, boot in the grounds. See this stuff first. But again, when you're talking economists here, this again, very, very powerful point here. The bulk in the drop in home prices has yet to come. The speed and scale of the adjustment and the price is uncertain. And again, the adjustment and scale is what? Well, for anywhere from 10%, 15 to 20 to 30. Some people are saying, if not more, depending on where you're located. So please keep that in mind. that stuff is not really here yet, it's going to manifest, and we're going to see some bigger problems. So, folks, if you enjoy the information I provide and like what's going on here in this channel, if you could do me the great honor and smash that subscribe button, I'd really appreciate that. And if you are a current subscriber, I think you are, if you could please hit the button again and put the bell notifications on, because I lose subscribers every single day, every week, every month. I don't even care anymore. I'm just saying, hey, let's keep the numbers up, all right? Mortgage rates soared to the highest level for the year. So going with all this on affordability or lack of affordability, U.S. mortgage rates soared towards 7% this week. This is back on July 10th, pushing away many potential home buyers as pressures for some pushed home ownership further out of reach. So that's what we're seeing right now. It's like it is becoming ridiculous here. The upward trend is being driven by a resilient economy, persistent inflation, and a more hawkish tone from the Federal Reserve. So basically, a 30-year fixed mortgage hit 7.22% on July 6th, reaching its highest point since November. So again, it always depends on, mortgage rates usually are published, and all this information, the Mortgage Bankers Association, whenever they summarize all their activity on a weekly basis. So it depends on what week we're looking at the article on here. But this is from July 6th, so it's what, it's a week ago, so it's not that far off. And they're saying 7.22. The chart that we showed earlier was 7.38, so we're not that far off. It just goes to show that mortgage rates surge after comments from the Fed. So Mr. Powell told Congress in June that the central bank has a long way to go to bring inflation to the 2% mark, which basically, when that happens, whenever as they say, whenever Jerome Powell talks and it's not dovish, it's hawkish, that'll spook the markets and that'll cause an increase in rates here. So basically, favors a more hawkish stance towards future rate increases. The recent spike in mortgage rates, pushing rates over 7%, will further dampen pending and closed sales units. It did. Pending sales is down again. I mean, it's always down. Every month it goes down. It's 20% plus down year over year. That's from NAR, National Association of Realtors. I don't have the chart here right now, but that's what was stated. So, and prices are still, pending sales are down in the New York metro area. That's just the guy they quoted, 15% with rates over 7%, and then the trend will continue. So it's tough out there to buy a home and to make ends meet here. Non-high-end buyers are edged out of the market. Basically, these high rates combined with low inventory continue to price many potential buyers out of the market. So we all know, if we take a look at the inventory at the sub 100 level, 100K, or the sub 250K level, which I would call affordable housing, sort of. I guess affordable housing is actually a higher number now. But basically, if you're, the majority of people can't buy it. As they were saying, the middle class is priced out of the marketplace here, right? So rates are still over a percentage point higher than a year ago, and housing affordability is still a challenge in many parts of the country, said MBA Deputy Chief Economist Joel Kahn. So there you go. So basically, everybody and their uncle is saying the market is horrible. You can't move. You can't do anything. People are locked into low rates. They're not moving around. So a lot of stuff is lack of stuff is happening right now. So what do? You got to venture towards stuff what I do here, okay? If you want to buy a property for cheap, or you want to buy investment property, because things are happening. So all this talk and rhetoric is really based on the retail market, all right? Just the average person doesn't do real estate, doesn't delve into real estate like we do, or do real estate investing, etc. But what I've always started or said since I've been working through this channel over the past couple of years is the fact that retail buyers, if you want good deals or better deals or not get taken to the cleaners, you're going to have to implement sort of almost like investor style tactics in searching for homes. Your real estate agent will only look in MLS. That's all they're going to show you. Oh, maybe the Zillow, off-market Zillow here and there, but those are few and far between listings. All right. So your real estate, agents, and again, I'm not bashing agents, but in a roundabout way, I kind of am, is the fact that they're only going to show you what they can get their hands on at MLS, because that's the access to the information they have. That's where they make their commission, make their money. And to be quite frank, going off market to find property costs money. It costs money to buy data. It costs money to market. It costs time and effort. All right. Then you got to work with the homeowners to get these things that are off market. So it's not easy, but it is easy once you sort of understand how the premise works. So the point being that this is where we focus: foreclosure auctions, bank-owned REOs, short sale, short payoffs, taking property subject to, looking at homeowner association and condo association foreclosures, tax deed foreclosures, probate, estates, zombie houses. I love zombie houses, right? Had a property that I worked on behind the scenes that was on the zombie house flipping show for the Tampa franchise down here. Underinsured, so things like hurricanes, floods, fires, the whole bit. There are people who are going to get stuck with maybe a damaged house and their insurance isn't going to cover it, so they're going to walk away. And the surplus, overage, the opportunity to engage in helping homeowners recover funds from foreclosure auctions where there is, the X number of dollars is owed and the bidder bids above that, so there's a surplus there entitled to the homeowner after other liens have been paid. So all these cool things we get involved in and we can do and we can help you. It's a matter of basically reaching out to me and we can go from there. So yes, I've got stuff on the go. I always do. Been working really hard on my new programs. Just taking a while because we got so many properties we're working on, so many deals we're trying to get through here. So that's what happens in this world. So that's a scoop. So anyway, everybody, been a while since I did a video. I apologize about that. I got to get back on track here, but it's the same old, same old. To be quite honest with you, I'm not as excited about doing videos because I sound like a broken record. The key for me is that I'm out there in the field doing stuff, right? Instead of just lamenting about it here on YouTube, I'm actually out in the field trying to make the world a better place through real estate. So if you want more information on what we do or how we do it, or to attend our events or our meetings here in the greater Tampa area, please reach out to me. That is my email. Give me a shout. We'll hook up. We'll discuss what you need or what's happening, and we'll try to do the best we can in the real estate world for you. So once again, thanks to the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you in a couple of days. See ya.